Hey everyone, it's Mike and welcome to the Order Flows Absorption course, Module 1, What is Absorption? Now before I get started, a brief disclaimer, this presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Passive performance is not necessarily indicative of future results. All right, so what is absorption and why it matters? Well, the easiest way to think of it is think of a sponge. What does a sponge do? All right, it absorbs and holds water until it releases it back. And big traders act in the same way. They absorb all the supply in the market, often at low prices, and then release it at higher prices, just as the way the sponge acts. And even though absorption is easy to learn, it does take time to learn and become familiar with it, enough so that you can apply it to the market. Now, the learning curve and process will vary from one trader to another. However, with the right education, it's just as easy for a beginner to learn as it is for an experienced trader. Now, the first step in understanding absorption is understanding the importance of volume in order flow. Now, volume is a raw form of market-generated information that doesn't need much explanation. It's simply the number of contracts traded. Now, within volume, you have bid volume, you have ask volume. From the bid volume and the ask volume, also known as offer volume, delta is derived. Within delta, you have max delta and min delta. And it's through volume, delta, max delta, min delta that a trader can really understand absorption in the market. Now, this is just, your normal footprint chart, right? To really understand absorption, you got to be looking at a footprint chart. If you're looking at a normal bar chart, you're not going to know when absorption is occurring because how can you tell, right? You're not looking at volume. You don't know if a price level traded 50 contracts or traded 5,000. I mean, it's just impossible to tell that on a normal bar chart. But on a volume footprint chart, right, you have delta, you have max delta, you have min delta, you have volume. You can see the volumes traded at a price, and that's important information to a trader. I bang my head against the wall sometimes. I don't understand why people are so resistant to looking at a chart with more information on it. Now, it's not a chart full of different indicators. It's just the information that's market generated. What traded at a price, what traded on the bid at that price, what traded on an offer at that price, and you can see how the auction process developed. Now, in technical analysis, volume 101, right? The basic belief is when price moves up with higher volume, that's bullish. When price moves down with higher volume, that is bearish. When price moves up on decreasing volume, that is bearish. And when price moves down on declining volume, I left out the word volume, that is bullish. Okay, I mean, that's just basic stuff, right? I mean, hopefully everybody already understands that concept, but you can see here, right? Making new highs, boom, big volume. This is crude oil. This is a 5-minute chart, and you're getting about 1,000 contracts every 5-minute period. Then boom, 9,000 contracts traded, new high. And then you're seeing as you're making these new highs, higher volume than what you were looking at earlier. You're looking at 3,000, 1,600, 2,300, 2,900, 2,400, versus before you're looking at, half of that, 1,500, 1,500. Now, it doesn't mean that, we make a new high, we got 9,000, the next bar, new high should be 10,000 contracts and 11,000. It's still increasing volume, much relative to what it was previously. If you're looking at a daily chart, right? If you go back to the old books on trading with volume, written in the 50s and 60s, the daily charts will show each bar having increasing volume. But this one bar, right? This doesn't mean this sets the new level, that 9,000. That for it to be increasing, it has to go to 10,000, 11,000. You've already got the jump, and you've sort of jumped to a newer level in here as you're going up. Can it be nice? Yeah, it'd be nice if every bar had massively increasing volume. This one was just a lot. But then you're 3,000, 2,000, 2,900, 2,400, 2,800. It's still increased over what it was previously. Now, volume is what differentiates prices, right? The key difference between A market exhibiting absorption and a market exhibiting consolidation is volume. With absorption, volume will be stronger than normal. And when I say normal, I mean what it was preceding the area that you're in, right? If you're looking at, like for example, right? All the charts I use in this course are 5-minute charts. And the reason is I wanted to keep it constant throughout the course, so you can see it on one set of charts on a certain time period, rather than, here it is on a 4-range chart, then here it is on an 8-range chart, and a 30-second chart, a 1-minute chart, 5-minute chart, and just jumping around. I think it might confuse people a little bit. Now, when I get to the last part of wrapping it up, I delve into different types of charts, 4-range, 8-range, 1-minute, 5-minute, etc. So you can see how it looks on different types of charts. But for the main instruction courses, it's on 5-minute charts. And when I say, again, stronger than normal, okay, what it was previously, right? Now, you can, honestly, I don't think it's worth the work as a retail trader to go back historically and say, yeah, between 5 and 5:30, your average volume for the last 30 days is 1,200 contracts. Okay, and then compare that. That would be your normal, but in trading on the fly, you're not going to really do that. It's just as easy to go back and compare what it was earlier, rather than set a benchmark for the last 30 days and do the research. You can. It's a lot of work. And maybe some of you that are technically inclined could write some program to do that. That'd be great, I think, because I know that when I worked at JP Morgan, that's how we would create the VWAP algos. Is we would look at a time period and take a snapshot of that each day, going back a certain amount of days, so that we know what we should be executing at that time. But for most people, you don't have those resources. Now, consolidation is generally average to less than average. And a perfect example is you're going to see consolidation before a major announcement or a number. Like, you're going to see the market consolidating, going sideways, doing less volume than normal, like before a Fed announcement, like the hour before a Fed announcement, or the a few hours leading up to the non-farm payroll numbers. That's consolidation. That I would not consider that absorption, right? Because generally you're going to have less trading because people are waiting. They're waiting to see what the number is going to come out, and that's not going to be absorption. You're not going to see the heavy volume at that time. People aren't going to really take a position right before a big announcement. So the reason a lot of traders fail is because they use price-based indicators because they think that the indicator will allow them to analyze the market objectively, right? They're like, well, I'm going to put this moving average. I don't have to make a decision. All I got to do, the only decision I have to make is, do I buy it when it crosses the line or not, right? They think that it removes some of the objectivity out of the market, but what actually they're doing is they're going backwards, right? They're looking at the effect on the market and not the cause. And to figure out and understand the cause of the move, you have to think, and when you think, you become subjective and not objective, right? It's, honestly, it's one of those things where, people really want computers to do everything for them. And, as a trader, I find the best traders are the ones that are able to take things in context, right? Yeah, sure, they're using a tool, an indicator to tell them something's happening in the market, but at the end of the day, they're the ones that put it in context to what's happening overall in the market. And by looking at the cause of the move, you can predict the possible effect it will have on the market and price. And for example, like this, right? Indicator madness. That's what I call it, indicator madness. What I got 4 indicators on here, right? I've seen people with 10 indicators on there for some reason. Maybe they rank them. Oh, I got 10 indicators. If 9 are bullish, I gotta get bullish. Well, what's going to happen is that one that tells you not to take that trade is the one that was right. But perfect example is, if you're looking at these indicators, like, oh my gosh, we're in overbought territory here, yet market still went up, right? And everyone's saying, oh, you got to sell it here. You got to sell. We crossed this line. We crossed this line. You got to be getting short. And they're so far behind on the curve. Look at this high. People say, well, we're overbought, but we're this market's still got another 50-cent move in it till he gets up here and starts to come off. By time it starts to come off, we come off, from 70 down to, 40. Now they're convinced, but you already had that move. If you're looking at the order flow, there's signs in the order flow that telling you, you should be getting short. There's not much signs in here on this move up really telling you to get short, right? So if you're following an indicator, it's telling you, hey, you got shorted here. We crossed this line. We crossed this line. We're in oversold territory or something, or overbought territory. It's just rubbish. And even, in the footprint charts, there's different types of charts you could look at. You have the delta footprint. I find myself looking more and more at a delta footprint because I just find it more information that is available to me that I want to use it. There's nothing wrong with looking at both a volume footprint and a delta footprint, side by side next to each other. You're not comparing one against the other, but maybe sometimes you might see something on one chart that you're not seeing on another chart. Now it's not a different indicator in the sense that, well, I got RSI, MACD, stochastics, moving average. It's information. It's market generated information, and that you can make a decision from. And when you get up to this first high here with this red bar, right? What are you looking at? Well, okay, let me see. Well, delta is still positive. Okay, is that a bearish sign? No, it's not a bearish sign at all. It's still relatively bullish. I know it's telling me that, hey, you know what? There's still some buying pressure in here. This market might go higher. When we finally get up to the high, what do I got? I got negative delta. Next bar, stronger negative delta. And even if I analyze the delta in the bar, I can see what was traded on the offer, what was traded on the bid. And what does it look like? Right? Well, it looks like someone came in and is hitting all these bids here. Is that bullish or is that bearish? Well, that's bearish, right? You got the delta confirming it, obviously. And more importantly, you start taking in context with what's happening. I get into this in the trade setups on what this bar looks like. This bar looks like, this is what I call euphoria. Everyone is just tripping over themselves to get into the market, lifting all the offers here, lifting all the offers here, lifting all the offers here. I mean, there's counter trade, 10, 130, 18, 8, 84. But it's mostly everyone just coming in. Oh, we're making new highs. I gotta get it long. My indicator, my 90% winning indicator says get long. So everyone's coming in here and getting long. Well, at some point, everybody's long. Well, what's going to happen is the sellers are going to come in. You got these high prices. Sellers now are attracted to these high prices, and they just come in and boom, just whack everything, whack everything. So that's why it's important to have, a footprint chart, whether a delta footprint chart or a volume footprint chart, so you can see how things are, how trade is acting, right? If you're looking at this volume footprint chart, you're high, you're seeing selling imbalances, right? If you're looking for the market to go higher, you should be seeing buying imbalances, not selling imbalances. So, when traders rely solely on price, they cannot have a complete understanding of market context. Price versus price analysis has very little meaning in the overall context of the market. Not every traded price is equal to another traded price. And if every trader viewed price the same, the markets would just trade one price. Traders mistakenly use price and value interchangeably, right? They're not the same. Price is what you have to pay for something, right? Value is what the item is actually worth. You can buy something below its actual value and get a deal, or you can pay more than something's worth, right? You go to the store, right? There's a price on everything in the store. You buy something based on what you think the value is, right? If you go into the store to buy your your milk, and it's, well, I'll say milk because that's something that's required. But you go in to buy your potato chips, and you're like thinking, wow, a bag of potato chips is $4. That seems a bit expensive. I don't think it's worth $4. Either you'll find one that's cheaper, or you wait for it to go on sale before you buy it because you think the value of that is lesser. Now, if you go into the store and you're because you got a party this weekend and you need to buy 5 bags of potato chips, and it's not on sale, you just buy it because so you got to pay more than what you think it's worth because you have an urgent need. But anyway, that goes back into sort of market understandings in supply and demand. Now, it's important to know that when there's absorption in the market, because oftentimes when you have absorption, that's where traders get trapped, right? Everyone loves to talk about trap traders, but not absorption. And think about it for a minute, right? The market's at its high and buyers are excited, right? They think the market's finally breaking out, but there's supply up at the high and just above it oftentimes. As a result, all the buyers keep buying. The market isn't moving higher anymore, right? Instead, the market starts ticking lower. If you're a trader, you're thinking, what WTF? Right? We've all been in that situation. This is it. This is, the moonshot. We're going up, and you get long. All of a sudden, what happens? There's no follow through buying. Instead, you got sellers all of a sudden hitting all the bids, and the market starts ticking lower. Right? This is a delta footprint chart, but you can see it oftentimes. Like, this is a 5-minute chart, so I spent a lot of time on range bars, but on 5-minute charts, right? On minute-based charts, obviously you're constricted to time. So at 12:40, new bar starts, 12:45 it ends, and so on. So this is where some of the power, I think, comes in on certain types of charts. Is you got to look at the chart, at the bar, and then watch what happens as the next bar is forming, right? We got this volume up here. Look at a new high, right? 12, 93, 11, 154, 148. Okay, everyone's coming in buying. There's people selling up here, right? Look at even here you got 101 traded there. So as you got up here, people are hitting these bids. These traders up here, these guys are trapped, right? They're stuck. We didn't go higher in the next bar. Instead, we started trading lower, right? These guys are trapped up here. Now, people like to, for me, this is the biggest fake news, misinformation out there in the trading world. Is people always talk about trap traders. Oh, you had these buyers up here, and they had to turn around and start selling, and we sold off. Well, you know what? It's only, what is that? About 300 contracts. Honestly, this is a market. Crude oil, it can absorb 300 contracts pretty easily. You see, even here, you got a delta of minus 288. So it's not out of the realm of possibilities that these people are getting out in here. And but people like to talk about trap traders as it causing massive moves up or down. Everyone's trapped up here. Not really. There are traders that are trapped, but what you have is that's sort of the trigger for a trader, like for you or me, to say, oh, there's trap traders. Well, why are there trap traders? You have to think of it in the opposite, is because there's sellers up here with supply. And then they're coming in here at these higher prices, selling the market down. You can see how it's transacting mostly on the bid here. Then as you get down here, there's someone keeping their foot on the neck of the market, offering it out at minus 258, 223, 76. You tick back up a little bit, 131. So you still got sellers in here. Look at this. You still got sellers in here, 200, 153. Now earlier, right, when you got up here, you transacted some decent volume, 248. Okay, that's good. Where's the follow through buying? Yeah, positive delta of 3 there. Not much. And then next bar, what's happening in the next bar? Market's just selling, hitting all these bids here. Bid. There's, again, this is a delta chart. This is not a volume footprint chart. This is just telling you what the linear delta at a price level is. So you see it's minus 38, minus 60, minus 35. So it's mostly people hitting all the bids in here. Then you come down here to unchanged, then boom. Everyone's getting excited again, lifting all the offers, a bit of euphoria, buying, get those highs, no follow through buying up there. Next bar comes in red, everyone's hitting the offers, even offering it out lower, offering it out as you go lower. Now, if you're looking at, the indicator madness chart, people say, oh, you got an inside bar in here, they'll justify it when we sell off down in here. When you get down back towards the moving average, this is where they're looking to get short. But where are you going to want to get short? At this moving average, or right up, up here in the red bar right after the big green bar, right? You see the big green bar, a lot of times people get excited. Hey, we're making new highs, got a big green bar, get long. But there's no follow through buying, right? These indicators don't necessarily give you sell signals yet. So, that's why, people talk about indicators, price-based indicators as being lagging. That's what they mean, right? You could see it in here, right? You get the big, strong positive delta, 1700. Oh my gosh, it's off the Richter scale. Get long. The next bar, minus 86. What the hell? The volume is still decent, 5,000. The big green bar is 12,000. But prior to that, some of the bigger volumes was 5,000, but, averaging around 3,000. But you're still averaging, slightly above here, 5,000, 4,600, 5,000 as the market's trading lower, right? So it's not just drifting lower, with lack of participation. You're seeing some strong selling in here with the strong volumes. Okay, so here, what do you do? Okay, this is your indicator madness chart. So you just follow this 9-period moving average or whatever this was. Here, I threw up on here. But, you have this nice low down here. This is very a juicy low to be buying on, right? Let's look at that move that came after it. Right, it's a beautiful move up. But again, if you're trading these indicators, what's the signal down here? There's just so many false signals, in every one of these indicators. You're just sitting there you're scratching your head. But if you're looking at the volume footprint chart, you see this 43, 20, 20, 14, 11. You have a stacked selling imbalance at the low, right? Market came down, probed these lows. Everyone is saying, oh, we're breaking out, we're making new lows. Well, then what happens? Market reacts back up. Where's the follow-through selling? These guys are trapped down here. Right? There's very little counter offer, and people aren't offering it down here. Where's, I traded 1 lot on the offer, 2 lots on the offer, 0, 0, 0. Where's the counter trade, right? If you're looking at this, and this is a 5-minute chart, if you're looking at this and you're thinking, you're back up here, right? It's a green candle. So you open in here at, what is that? 597. 5 minutes, 4 minutes later, you're trading up here at 615, 20 ticks higher. You see this, trap traders, that's worth getting long on. Catch this move. Next candle, big green candle from 20 all the way up to 40. Next candle by itself is already 20 ticks. So you get that information, you get in a hell of a lot faster than you're getting in this bar or immediately in the next bar to catch some of this move back up. I'm not saying you catch the whole entire move all the way up to the close, but there's enough meat on that steak for you to enjoy. Again, people always say don't try to pick highs or lows, and I think that's bad advice because it's disingenuous, right? There's a lot of money to be made trading around highs or lows, and when people say don't try to pick highs or lows, I think they mean it in terms of drawing all these bat wings and projections and things like that. Let the market tell you if it's forming a high or a low. Basically, if the market's at a high and delta is increasing but price isn't going higher, your ears should prick up, right? Just like like a horse, right? It hears a sound, well, the ears start standing straight up, turning around. You got to get ready to look for signs to get ready to sell as the high could be forming, right? Imagine, market's trading up near its high. We're got aggressive buying, and delta's getting strong. All of a sudden, price isn't going higher. Why isn't price falling? These are questions you should be asking. They're two obvious signs you should be looking for. Aggressive buying starts to weaken. The buyers are drying up. Positive delta should be getting smaller, ideally. Or aggressive selling starts coming into the market, and it's going to show up in two forms. First one will be the delta. So you should either start seeing small positive delta or negative delta in the bars off the highs, or you should start seeing selling imbalances in the bar. So this is what I mean, right? We're going new highs. Volume is increasing, right? You're making that new highs on increasing volume, 7,000, 4,000, 7,000, 11,000. Then you get up at 2,000, 6,000. So you got your big volume bar on your high. But look at the delta, 600, 536, 315. And I discussed this in the one of the foundation courses on delta, this is a bearish sign by itself. But when you add in, what's happening here, then what happens here, these are the questions you should be asking yourself as a trader, right? I mean, yeah, market's going higher on positive volume. That's what you expect, right? But at some point, market's going to stop going higher and it's going to get ready to sell off. And as a trader, you got to look for those signs, right? You can't just say, well, we got the volume dropped off to 6,000, so it dropped in half, so that's a very bearish sign. Well, it just started going sideways. But what you should be looking for are the other signs. Look at this. So for the next 1, 2, 3, 4, even 5 bars, look at the delta. Minus 288, minus 100, minus 300, positive 6, which is nothing, minus 600. You should be already convinced that we're not going any higher, right? And what do you see in here? You're starting to see some selling imbalances come in. Selling imbalances. And then the market falls over. So, I know a lot of traders. I've been blessed in my life, and far as the trading gods have introduced me to a lot of traders over the years, going back to the 1990s, and many of them are the epitome of success, right? The $1 million home. I knew a guy who bought a house, and this is in Singapore. He bought a house, and the before the Asian financial crisis in the 90s, and he paid a lot of money for it. And he literally was been underwater on this house until, after the crisis in financial crisis in 2008. But by this time he had made so much money he didn't care that he bought a house worth like 10 times the price. But these people, right? They're not the Instagram type of millionaires. Sure, they have the $1 million homes, the fancy cars, they go on the first class vacations. They got the country club memberships. They don't go around posting it up on Instagram. That's funny. I was looking at this. I enjoy Instagram. There's a lot of funny memes. I love memes, and a lot of funny pictures. Sometimes I look at Forex memes and stuff. I saw this Joker. I gotta call him a Joker because he's wearing this outfit. Sitting on a green car. Sort of reminds me of the Joker from Batman, and he's wearing like this Gucci tracksuit and Gucci hat and stuff. I have never ever met a trader in my life that's dressed like that, and trust me, I know a lot of traders. Maybe that's the new wave, but I doubt it. That's what I call these Instagram millionaires. But the thing is, right, if you ask a lot of these very successful traders to explain the method of their trading, you never hear them talking about moving averages, RSI, MACD, ADX. Everything that the popular trading books tell you is the way to trading riches. Can you make money with those? Possibly. I'm not going to discount it completely. I've never found any value in it, and in all my years of working with other traders at an institutional level, I've never seen. I might have seen, but I've never really seen people have them on their, on their desk, charting, looking at moving averages, RSI or anything like that. I take that back. Maybe some moving averages. People. Farmers like to look at 200 moving averages, 200 period moving averages, just sort of get an idea of the trend. But other than that, they don't really use technical indicators. They read the market. They listen to what the market is telling them in supply and demand. And while each of them trade differently, there's no exactness in their trading, right? There's no mathematical equation that solves the trading puzzle for them. Right? Instead, they watch what's happening in the market and what's happening outside the market. Most traders fail because they start using price-based indicators, which, through different mathematical formulas, filter out the, quote, noise out of the market. Right? When you use price-based indicators, there's a layer between you and the market. Right? You gotta just learn how to trade. Right? It's just like, I've used this quote before. I think it was Sir John Gielgud. It was in a movie with. Is it like Dustin Hoffman? And Dustin Hoffman is like trying to get into character or something like that. He's going through all these steps to get into his character. And John Gielgud says, boy, why don't you just act, rather than, having to go through all this different stuff to get into the character you want to play. And it's the same way with the markets, don't have that extra layer. Just trade, right? Trade on what you know about markets. So, the other thing I want to talk about is price exhaustion, because it's kind of related to absorption, because when price exhaustion happens, it happens for two things. One, buyers or sellers are just tired, right? If you're going high, buyers are just getting tired. The last buyer has bought, or if the market's making lows, the last seller has sold. But the counter side of it is there's absorption there, right? There's going to be somebody that's offering the supply at the high, or bidding at the low. And what it is the market's just lower, then comes back towards the high again and tests it, but on less volume. And at this point, buyers are becoming exhausted, and there isn't much volume on the second attempt at the high. Again, it doesn't have to be like a second attempt. It could happen on the first attempt as well. In other words, less volume at the double top. It just looks better optically sometimes on a double top. But, instead of the big buy orders coming in, you're now seeing, the one lot wonders coming in, trading price action, right? Because price is going up here. So, a price action trader, I got to be buying it. But they're about to get their faces shoved into the dirt. Now, some people, I call it price rejection. Others call it price exhaustion. Others call it sequential decline. Others call it tapering off. It depends really on who you talk to. And, what it's going to look like, something to this effect, the less volume on the way down, down in here, right? People are going to say, oh, this is price exhaustion here. You got 5, 133, 419, 26, 41, 368. They like to have very symmetrical numbers, 183, 1693, 1297. The 1693 should be here in the second level, because it has to be very symmetrical for them. And if it's not, then technically it's not price exhaustion. But they'll claim it here. Sometimes I think it's a little bit more of coincidence. I don't say coincidence, but that's just how the numbers land sometimes. Now, that's not to say that price exhaustion, right? You're really looking for lesser volume. I would not, even if this was 183, 1297, 1693, I wouldn't consider that price exhaustion, because the volumes are still relatively strong. Really what you would want, is less volume, 5, 133, 419 right up here. But that's the thing is, right, when you're trading, with a quote computer algo, right, it's just looking at these numbers. Oftentimes, they don't really take into account the volumes, and that's where you as a trader can make that difference. Say here 336, 219. Look at that. You got price exhaustion here going up. Well, okay, if that's what you want to make of it, and sometimes people, they don't even differentiate between red bars and green bars. I think you have to look at red bars and green bars, because you want to have confirmation that the market's happening. You're not going to say, well, you got price exhaustion on this red bar down here, buying price exhaustion 272, 373, 904. Really, you're looking for a reversal, right? Price exhaustion should be a reversal signal, not just happen anywhere. There's some softwares will put a box around here, but honestly, you don't need that. You could just look at your chart. I know everybody likes to have things automated for them so they can trade a million different markets. Hey, if I can make $100 in one market, I could look at 10 markets, make 1,000. Stick to the one market. Oftentimes, I think it's more going to be more effective for you. So again, I hate to bang the drum, beat a dead horse, whatever cliche you want to use, but you need to understand and know what's happening in the markets right now. By right now, I mean understanding the dynamics and trading activity occurring on the bid and on the offer, right? The people who move markets trade based on what's happening right now, not based on price indicators. When you talk to an institutional trader, at the end of the day, if you're out there having beers with him, you ask him, why did he buy at such and such a price? Oftentimes the reply is going to be something like, well, it looked like a good buy at that price, right? You won't hear him say, touch the lower Bollinger Band or price broke the 200-day moving average, right? The reason I bring this up is not to disparage price-based indicators, but rather to explain and drill into the importance of understanding how the big traders think, right? The insight will help you see what they're doing in the market so you can anticipate and follow what they're doing. Now, there's a lot of good books on trading. Honestly, I think the best books, right? For me, any type of book that is a biography on either on whether it's a trader or athlete or even a politician. I get sick of some of these politicians. I like reading biographies and hearing what other people went through in their lives. And if you've read these stories of traders that experience the crash, I'm not talking these little flash crashes, but I mean like the big crashes in the market, and how some of these guys made their fortune. They've come up. There's a few traders. I think it was Louis Borsellino. Bought the S&Ps. He was the one that stood up and said, I think this, as there was no other bidders in the market, he stood up, he bid, put a bid in there. Someone hit his bid. Next thing market rallied. Guy made like $1 million in a minute. Went to the bathroom and immediately threw up because he realized he could have just lost that much as well. Same thing with the Nikkei, right? I remember, back when the Nikkei crashed, some guy on the floor, Nikkei floor, bid 5,000 for the Nikkei. Well, that was the only bid. So people hit it. Next thing market jumped up. The guy made a boatload of money. And that's what you talk. When I talk about, well, it looked like a good buy. These guys aren't sitting here trying to calculate their Bollinger Band on their hands and say, oh, okay, well, yeah, we're at the lower Bollinger Band. I'm going to buy now. It's the big traders are the ones that supply the support or resistance in the market. It's the guy that step up to the plate. Okay, I'll bid 5,000 on 40 lots like that. So again, don't get caught up in trying to think indicators are the greatest thing since sliced bread. People were trading long before indicators and making a lot of money. Now, generally absorption should occur around the edges in the markets. And what happens when the market's moving? For example, the market's moving up, pauses, a lot of volume goes through. It could be someone trying to hold it down, maybe defend a level. Again, look left on your chart. Get some sort of idea of what the market's doing. Or it could be someone working something against cash. Honestly, you won't know, but you have to make an educated guess. Look for imbalances in the bar. If you start poking through the level, ask yourself, is there aggressive buying going on? Look at the delta. Is it getting stronger? Once you get past that area, watch what happens when you come back to it. Is it being defended? And, perfect example, we're coming up here. We're at our highs here, right? You got your new high. Yeah, you got nice volume. Next high, okay. Yeah, you still got some decent volume. Still got make this new high. Well, you got negative delta. Volume overall is still strong. Next bar a little bit lower. Negative delta. Okay, still decent volume. A little bit less than it was earlier. Now we're down to 10,000, 10,000. So volume is drying up, right? 10,000 again, but then boom, 17,000. You make that new high. But what's changing in here, look at this, negative deltas in here. You sort of saw these signs earlier, right? It might have been worth it to some of you guys to get short in this green bar. And then, the market did tick up, make a new high. When you make this new high, this is what I was talking about earlier, right? The price exhaustion, right? First time you hit that high, 15, 632, 867. Second time, 5 lots, 500, 819. So this little pocket of volume up here is lesser than it was earlier. Not much lesser, but lesser still. And you do have a divergence. You got your new high with negative delta. And all of a sudden, but look at this high, right? What do you see? Selling imbalance, 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 selling imbalance. Where's your buying imbalances? There's not many. You're overwhelmed with selling than buying, right? It's indicative in the negative delta. Do you think this market's going higher or lower? I think it's got more of a chance to go lower than go higher. You got the selling imbalances, you got the negative deltas, volume. It got light in here, but then it's picking up here. 17, 15,000, 13,000, 17,000. It's getting stronger again, and you're seeing stronger negative deltas. And here's one. This is crude oil. It's a 5-minute chart. Boom. Big selling coming in here. 15,000 contracts traded, whereas before you're trading, earlier it was 10,000 was your biggest volume. Okay, big negative delta, 15,000. Get this little green bar here. The next bar, boom, new lows, 15,000 again. Strong negative delta, 1,100. Stack selling imbalance. But what's happening? Things are changing. You still got some okay volume, 7,000, 6,000, 7,000. It's kind of going sideways, building up some positive deltas in here. Now, are you seeing a lot of buying imbalances? No. But are you seeing a lot of selling imbalances? No, not really. Now, just because you have absorption, right, a couple things can happen. You can go sideways, you can go up, you go down. And I'll talk about this later. One of the signs that I'm always looking for is looking for some sideways action with inside bars. Again, I don't want to start getting into some sort of, inside bar course or anything like that. But really what I'm looking for is, do I have an inside bar? Inside bar. Once you start seeing inside bars, I'm kind of looking for some sort of reversal. Now, yeah, you could say, well, you have an inside bar here. How come you didn't get the reversal? Well, we haven't hit our low yet, per se. Oftentimes before you hit a low, right, you need that. Well, you haven't hit your low for one. Your low of the day is this red line, but you need that big delta volume blow off, right? And you're seeing it in here, Then you're getting this. You made your new low. You got your inside bar here. It's just sort of hanging around down here. But what's happening is delta's picking up, delta's picking up, delta's picking up. And what I'd be looking for is, you don't really see it in here, but it's kind of subtle, actually. You're going to be looking for the volume to start picking up. Delta's obviously to start picking up, because here, you got delta of 1,000, but doesn't do anything. 200, 18 is nothing. 285, 595, 282. I'm looking for either a volume jump or a delta jump, and you get it right here, 1175. This is the trigger bar right here. I can't honestly say that this is a good buy somewhere in here. I would love to, but I'm not really have any sort of trigger till you get to this bar and the market jumps up. So again, no one can predict the future, right? The future is always unknown, and knowing order flow does not change that. But order flow does help the trader understand what's happening right now in the market. Once you understand what's happening right now, you can make better trading decisions about what's likely to happen in the future. So this concludes Module 1. In Module 2, I'll explain the different types of players involved in the market and how they trade and create absorption, accumulate, and distribute supply. So I'll see you on the next module. Bye-bye.